Hey, good morning, everyone.
Good morning, Professor.
Good morning.
Good morning. Good morning. Good morning, Professor.
Good morning. Good morning, Angelica. Good morning. Well, how's everybody? It's it was well, I don't know when I saw this, clear day yesterday. When I last saw it, I guess it must have been, not that long ago, but after the rain, it looks, I don't know if you can, if you have the same weather as I have, if you're not in uh, NYC area, but I guess the storm has just passed by. Now, so we are, how many people? I see 10 people here in the Collaborate, but let me see. In the discussion board, let's see how many people are there. In today's forum currently, yeah, well, I have nine people in, no, actually eight people in the discussion board, but I have 10 people in here in the Collaborate. So if you haven't signed into the discussion board yet, please do so ASAP, okay? Because you need to do the attendance report within the first 30 minutes to validate it as present, right? And that's the first order of business. Let me share my screen with you. All right, so everyone can see my screen, right? So do you see today's forum? Everyone, do you hear me?
Yes.
Okay, good. So you see today's forum. And if you don't see your name there, right, you must do the attendance report ASAP. And I also mentioned that in the announcement. Okay, class protocol, right? That was the second posting, right? So, and also when participating Collaborate session, this is a recent posting. The first order of business is to establish the physical proof of your attendance in the discussion board, right? So you do that before coming to the Collaborate session, okay? Now, so that's not your section. 1101 is your section, okay. You have already two videos that are, more than 5 days old, and so I also made, posted just today, right? How to retrieve the videos that are more than 5 days old. So I have YouTube channel. I think I mentioned this before. So you can look it up. I mean, it's there permanently, right? So please check it out, read it, and check it out. So so the last time, last class, basically we were talking about the difference between holding period return and annualized return. I mean, we were just starting to, we're just starting on it. And I said holding period may vary. Holding period may vary between different investors, and also across different securities, across different, different, assets. I mean, if you, and mostly, the main reason there's a difference, and it's obvious that, holding periods between different investors cannot be the same. I mean, I can hold, I bought Tesla last year. I mean, I bought Tesla. I believe I bought it this year. I missed all the good times with Tesla because, if I had bought Tesla early 2000, probably early 2000, Tesla was still about, somewhere between 200 and 400, and then it went up to about 1600. I should have bought it then, but I bought it after all those, still. So after I bought Tesla, and I don't have too much trust in Tesla because, still price is, overvalued, right? Tesla price is overvalued still. It's around 700, I believe, today. Let me just check where it is. The main reason I didn't buy Tesla last year was that I didn't believe in Tesla. It was 739, 737, 738 today. It's because I thought it was overvalued and it would, price would come down. But then, investors generally don't care whether it is overvalued or undervalued. They just want to jump into the bandwagon while that bandwagon is on the run. So, I mean, on the rally, they just want to ride the crest of the wave of the rally, not caring about the the fundamentals of the company. It's just, they just wanted to take advantage of. But the thing is, then, would you know when to bail out, right? How would you know when to bail out? Yeah, see, this was, when was this? This is like December 2019, so early January 2020. It was still like, and you think, oh, it was only $85. No, that is, I've been telling you, that's prorated after the split, right? There was a split here, and this split was when? A 5-to-1 split, okay? July of 2020, they had 5-to-1 split. So prior to, and it was after split, the price was 216 and 286 actually. During one day it went up. So after split it was 286. That means prior to split, that times 5, right? I mean, it's almost $1,500 before split, right? And Tesla wasn't really, and even now, it is, after, when this was like, January 2021, this year, right? It reached, 719. 793. 793. Currently about, seven. 738. Now, so people generally don't care, especially when how many of people around you that are investing. How many of them are really caring about fundamentals of the company? And they don't care. I believe those who bought Tesla early on, they just they were happy when the price was artificially pumped up, right? So the question is, they just they just want to bail out. They just want to sell and bail out at the right time. But if you miss that timing, and who knows when it's gonna turn around. I mean, the inflection point. Nobody can exactly pinpoint that inflection point when that happens. There are predict some techniques called reversal. Reversal of strength, RSI in reversal of strength index. But then it's just again, it just gives you a signal, but that signal is not. It's just a range. It's not really pinpointing. I mean, it could be, or but if you can, there's no scenario. There is no exact scenario such as oh, I sold it and then the price just dropped. Now, there is no such there is no such exact signal, right? If the price doesn't fall after you sold, then you will just again blame it on someone, right? I just sold too soon. I could have stayed. Well, if you stayed in and just one day late, one day too late, right? You could be the back holder, making a nosedive. But anyway, I was digressing a little again. But the point is, since holding period varies, we need some standardized holding period, right? So the standardized holding period is annual, annualized return. Now, here's the thing. People use the term annual and annualized interchangeably, as if are the same thing, but they are doing this in confusion. Actually, the word annualized and annual are two different things. Why? First of all, if it is annual data, right? Any annual return, something like annual price, annual return, that means the data already exists in that annual format, right? In other words, they collected the data at the end of the year, price data at the end of the year, then that's the annual data. So the data already exists in the annual form. But annualized means, the data wasn't existing in annual form. It was, it could be 30 days. It could be 30 days. I mean, your holding period could be 30 days. Say, let's say you bought Tesla in January of 2020 and sold it, held it for 1 month and sold it in February of 2020. you had it just for 1 month, and let's say you made 20% return for holding it for just 1 month. It's obvious. It's obviously very great return if you got 20% in just 1 month. But how do you annualize it then? I mean, if it was annual, so you might think, because I got 20% return for just 1 month, shouldn't I just multiply it by 12? So 20% times 12. That must be 240%. Look, that's crazy. That is incorrect. That is completely wrong, right? Why? First of all, you didn't hold it. You didn't hold it for 1 year, so you never know. Nobody knows what the return would, how the price movement would have been if you held it for 1 year. So, without holding it for 1 year, you wouldn't know. You might say, "Oh, don't we know already? Because we are in 2000. We're in 2021, and we know the data for 2020. Now we know. But let's say we are in February of 2020. If we are in February of 2020, you wouldn't know how the price would have moved, for the rest of the year. And then just based on, January to February return, if you're saying, I had 20% return, so I would have got, 240% if I had it for, the whole year. No, it can't, because obviously, there's no way it could be like that, because there's no guarantee that the Tesla's price movement. I mean, in case of Tesla, we already, but you would never know for any stock X, any security X, any asset X. There's no way of knowing how it would have behaved in the future, in the coming months, right? So if that is the case, how do you annualize it? Well, if that is the case, then we go back like 1 year, at least 1 year, or 5 years, normally 5 years back, and collect the monthly price data, monthly price data. I mean, if there's returns data, we can already use it. But if returns data are not necessary, because from the price data we can calculate return, so it's not a big deal. But if you have returns data, monthly returns, for the last 5 years, including January to February, right? Including January to February 2020. So if you have 5 years worth of data, then there will be 60 data points, 60 monthly data point, monthly returns data. Then you can take the average of that. You can take the average of that, and so if the monthly return on average was 10%, right? On average, if the monthly return on average was 10%, what you can do is, 1 plus that 10%, so 1.1 raised to 12, raised to 12th power. And that's going to give you annualized return. But anyway, the reason I'm talking about that is because, annualized return is the standardized return, standardized unit for return, because everything is, annual, annualized. When you, for example, the most basic bottom line return on the money is interest rate, because if you put your money in the bank, right, what you earn on that savings, right, is the most basic return on the money, on your money. Um, of course, bank interest rate is very, very low, and it's because it is riskless. Because if you put your money in the bank, your principal is guaranteed and the interest is guaranteed. So it's riskless. So whatever is riskless is must be paying the lowest return, because return is basically a compensation for taking the risk, right? As the risk goes up, then the return must be higher. Now, so but to you might wonder, so annualized return is basically average, right? You average, all annual data for if you have annual returns for 10 years, you have. But then when we say average, most of you understand simple average as the average, right? Because most of you are thinking, average is, something like sum of all the numbers, sum of all the data points divided by number of data points. In other words, that's simple average, right? A simple average, but there isn't only simple average. There is simple average and weighted average and geometric average. Okay. Simple average is also called arithmetic average, and that's what you understand as average. So average or mean is simply the sum of that means sum. Xi means random data, random independent data point. The subscript I stands for individual. So it's an individual observation, right? Data comes from observation, isn't that right? You have to observe something to get the data. And so this means, where I runs from 1 to n. 1 through n. N can be any random number. So, in this case, think about it. Simple average is used when the data points are not correlated with each other, right? When data points are uncorrelated with each other, or independent of each other. For example, we can use simple average. I can use simple average if I take average height of the people in this class. Okay? Why? Because there are 25 people in this class, 24 actually, but let's say 25 people. And how do you take the average height? Of course, I will have to collect the data, height data. I will have to measure your heights, and I will have to sum it up, right? I'll have to add them up, all of them, and divide it by 25, number of observations. Now, and your heights are not correlated, isn't it right? None of your heights are correlated with each other, right? Your height is independent of my height, and his height is independent of her height. I mean, it's all uncorrelated, and all these observations came from a single point in time. Okay, in other words, the data come from all the same time, not from different times. It's not like one of your height was measured 2 years ago, another person's height is measured today, another person's height is measured 5 years ago. It's not like that, right? Obviously, then the average means nothing, right? If the data comes from different time points. You understand? That's why it's called latitudinal data, latitudinal or cross-sectional, because also static time. It comes from static time, or synchronic, because they all come from the same time. and they are all uncorrelated, independent of each other, then that's simple average. But if the data is correlated, then you can't use simple average. For example, if I'm taking the average growth rate of your height, right, then I will have to do it individually, one person at a time. Isn't that right? And I will have to make observations of your growth year by year from when you were 1 year old. And if you're 20 years old now, I have to measure your height from when you were just born and when you were 1 year, 2 years, 3 years. If at the end of each year I made observations, I have 20 years worth of data, right? And if I take average of that, look, I don't take average of that because then, the height will be, the average will be your height. That's meaningless because then it will be sometime when you were 12 years old. The height of the time when you were around 12 or something like that. So that's meaningless. But in this case, what I can do is I can measure the average. I can take the average growth rate, annual growth rate of your height. Make sense? But then in that case, the data is, each data point is correlated with each other. Isn't that right? Your height when you were 12 years old is correlated with when you were 11 years old, which is correlated to with when you were 10 years old. I mean, old, if you're 20, your height now is correlated subsequently with every previous year height. Make sense? And in that case, you can take, and then, each year, you can measure the growth each year, right? Because, this year's height minus last year's height is the growth, this year, right? Between last year and this year. So for the growths, annual growth, I can take the average. And in this case, I need to, I cannot take simple average. I have to use geometric average. Okay. So although, so the opposite concept of simple average is weighted average, and the opposite concept of arithmetic average is geometric average. Now, this may sound a little weird. I mean, if arithmetic average is the same thing as simple average, I mean, can we not say opposite of arithmetic average is also weighted average? Yes, you can say that. I just wrote geometric average here because I had to introduce it somewhere, right? Another reason is geometric average is also a kind of weighted average. Okay, geometric average is, in fact, time-weighted average. Okay, and what is weighted average then? And weighted average is, a good example of weighted average is your GPA. Okay, your GPA is, and this was well explained in the main lecture. It's well explained in the main lecture, so I'm not going to do that anymore. I'm not going to go into, but once again, just to briefly touch on that. If you took English, math, some ethnic studies, art last semester, and you got B plus B, A minus A, and B plus is, in numerical points, B plus is 3.5. That's called grade points. In numerical value, B plus is 3.5, B is 3.2, A 3.7, and so on. So you might think, oh, if I add them up and divide it by 4, then that must be my GPA. No, that's wrong. If you add them up and divide it by 4, then it will come out as 3.6. But that's wrong. Why? Their weights are all different. Look, English is 3 credit, math is 4 credit. This ethnic study class was 2 credits, art class 1 credit. The credits basically reflect how many hours per week the class meets. 3 credit course means the class meets 3 hours a week. Four credit means 4 hours. And then, so something like this, art class, 1 credit, that means just it meets once 1 hour a week. And also the reason they meet more intensively, I mean, math meets the most. And that means, why? Why is math, 4 credit? Why do they have to meet 4 hours per week? 1 more hour than any other class. It's because math requires most brain power. I mean, all these, weights reflect the cognitive ability, cognitive efforts you have to, the cognitive, abilities and efforts you have to put into studying and learning and studying that course, right? So math, there's no dispute. Math requires most brain power, right? Compared to art or anything like, humanities, like, ethnic studies. Math, compared to anything, compared to English or history, math requires most brain power. There's no dispute about it. So then if they have, so weight means importance. So you have to, that means, you cannot just take the simple average. You must weight them by their importance. You understand? You must weight these numbers by their weights, their importance. So this times this is this, this times this is this times this. So they are weighted by their own importance. And then you divide the sum of all these numbers is this, sum of all these numbers is this. You divide this by this, and that's the weighted average. Okay? That's GPA. All right. So I'm not going to go. So now let's think about the geometric average. And to understand geometric average, we will need to use house value example. So I want you to open this file. Okay. You must have this file in front of you, and it is this is your section, right? 1101. This is the Excel file, right? It says clearly, you must download these, right? You must download these files. It is imperative, right? So do you have this Excel file open in front of you? Do you have this Excel file in front of you? Let me know. Please say yes or no. And if you have it all in front of you, I want you to clear out everything except the initial data. Do you have it in front of you?
Yes, and this was the house value and geometric average Excel sheet?
Yeah. If you have downloaded it, just leave it there. Just delete. If you opened it in front of you, if you have it open in front of you, just clear out everything except the initial input. I mean, initial data must be there, because if you delete it, then you will need to download it again, right? You need to have the initial data there. Let's see. Yeah, the file name is house value and geometric average. That is the name of the file. That's the previous one is, this one is the PDF file that I'm, that is this file, and then and it's obvious, you must have if you have downloaded it, you would know which one is PDF file and which one is, Excel. These two are Excel. It's this one. So if you have it now, okay. So you cleared out everything except the initial data. So now let's take a look at this. So this is basically a house value example of the data series of house values between the end of 2005 and end of 2016. Okay, and then at the end of 2005, you bought this house and you paid. This is the house value at the end. Of course, this is we simplified the assumption. We are using simplified assumption that you bought the house at the end of the year, just to make it, for our thought experiment. Make it because in reality, think about it. Nobody buys, a house on the last day of. I mean, it's possible, but not everyone buys a house, at the end of the year. I mean, it can happen at any time during the year, right? But as I told you, the data must be at the end of the year, because I've been telling you when if you look into the stock market during the day, right? During the day's trading, right? There are four possible price points, right? Four price points, isn't it right? Opening, closing, high, and low, right? You have the price at the beginning, at the opening of the market. At 9:30, the market opens, and there's the price that's at the opening of the market, and then at closing, at 4 o'clock, the market closes, and at that time, there's close the price at the closing price of the market, right? At the closing of the transaction, trading of the day. And during the trading of the day, during the day's trading, there's high point, right? And the lowest point, highest point and lowest. Four price points, but then none of that matters. I mean, except the closing price. Why? I've been telling you, closing price is the conclusion of the day's transactions, right? Only the closing price is the conclusion. That's nothing else matters. Opening, highest, lowest, they are not the conclusions. Conclusion of the trading, of the day's trading, is always the closing price. And also think about it. During a year, the house values may fluctuate. It may not fluctuate, daily. It can fluctuate daily, but then not like stock market, not like every minute, not like every second. House value wouldn't fluctuate like that. House values would fluctuate at a more longer interval, right? But anyway, no matter how high during the year the house value went up, or no matter how low it went down, no matter where it began, right? They all don't matter. What matters is the at the end of the year where the price is. That's the because that's the conclusion of the year, isn't it right? So, although in reality you don't buy, you may, but you would rarely buy the house at the closing price of the year, right? But for the sake of our thought experiment, let's assume you bought the house at the end of 2005 for $150,000, and at the end of 2016, you sold the house, and the price was and at the end of the year $500,000. Now, what can you tell? During these 11 years, it's actually 11 years because from the end of 2005 to the end of 2016, it's 11 years, right? And also you can, so everything is as of the end of the year. And also end of 2005 is the same thing as the beginning of 2006. Isn't that right? Because think about it. People just mindlessly, they don't think that much. You would be surprised, how just thoughtless generally people are, especially when you are in your 20s and 30s. You are not very, what I'm saying is, I'm not saying you're not thoughtful. You're just being, your mind is not that exacting, right? But everybody knows that when the clock strikes 12 midnight, right, on December 31st, 2020, that's the same thing as 0 hour January 1st of 2021, right? Can there be any dispute about that? The end of one year is the beginning of another year. So this can be also considered. This is the end of the year price, 2000. That's also beginning of, at the beginning of, price at the beginning of 2006. But it doesn't really matter where it was at the beginning, because 2006 will be represented by end of year, end of 2006 price. Right? Makes sense? Because it's the conclusion, right? That matters, right? So over this 11-year period, right? Over this 11-year period, over this 11 year, the capital gains, it was, simply this minus this, isn't it right? Capital gains. Also, annually, year by year, the capital gain is capital gain for 2016 was this, isn't it right? And then for 2015, it's the same logic. That will be B3 minus B4, and but I don't want you to do it one by one, because it's going to be tedious. So what you can do is you can copy and drag it all the way down. Okay, because then it's the formula that gets copied. You can. What I did was I simply did. When you move your mouse around, if you select a cell, first of all, you see the border line. You will see the border around the cell, and only in this corner, right? I call that southeast corner. Only in this corner you will see that the border is broken there, and there is a square dot in that corner. So when you bring your mouse to that corner, the mouse turns into a thin black cross, right? Normally, the mouse, when you hover around, the mouse is a fat white cross. But if you bring it to this corner, it turns into a thin black cross. That means you're ready to Excel is ready to copy and paste. So you just gently hold down the left mouse button, and then just drag it down. You don't have to drag it down all the way down to row 13, because row 13, we don't have data for 2004. So, I have something filled in here, which is just simply this minus this, right? 2006 price minus 2005 price. So you just drag it down only to, and then these are capital gains each year. this is capital gain between 2016 and 2005. So in other words, what am I doing here? What I'm trying to do is, look, I want to find, first of all, the holding period return. But to find the holding period return, I have to find the capital gains between price at time t and price at time t plus n. And in our example, time t was 2005, right? And time t plus n is 2016. So n is 11 in that case. So, right? So if you got that, and then another thing, we can have two scenarios. We have two scenarios. One, when you buy a house, it can serve two purposes. One, you use it as your residence, right? So it's just your home. And two, you use it as a rental property. So in other words, you sublet it, right? If you use it as your home, then you will see capital gains or capital losses over the years. You will see your house value either appreciate or depreciate. Most of the times, as long as the population is growing at a faster pace than, at a faster rate than the availability of housing, then the value of the property will have to go up. And in large cities, generally, space is limited. Population is, concentrating in large urban areas. Of course, the property value will have to go up. Some years it went down. As you can see, there was a negative. 2007, it saw a drop. Anyway, in reality, 2007 there was a housing market crash, and then this year there was also a drop. And then there was no change between 2014 and 2015. And then second, so that is the first scenario. First scenario, you bought this house and you use it as your home. Okay, that's it. In the second scenario, scenario two, you rent it out. Suppose this was a four-story home, four-story building, and you and on each floor, every floor was like 2 bedrooms and 1 bathroom every floor. Two bedrooms, 1 bathroom every floor. Then you can just if you're a single person, or you're living with your partner, or you can use one floor, maybe the top floor, and sublet the other floors, right? So in that case, you can. So you rent it out from year 3. I mean, first year, second year, third year, you didn't rent it out. You probably had to do some renovation and get permit from the. You have to apply for permit from the city and housing department to use it as a multiple family home, or multiple household units. Multiple household building. So it took some time for you to turn into a sublettable property, and then from year 3 4 you rent it. Obviously the these are annual rental incomes. If it is monthly 1,500, then, and then from year 5 4 5 6 year 6 10% raise in rent, right? And then from year 6, 7, from year 8, right? Rent went up to 2,000, and so on, right? So you can also then, in scenario 2, you not only have capital gains, but also you have some of all the additional cash flows, right? So I can also do, I can simply copy this and paste it over then it's summing up everything there. So when you have this, then you can find okay. So again, first of all, scenario one. What is scenario one? Holding period in scenario one is simply what? Capital gains over initial investment. Exactly what I did there is exactly this with this term 0, with 0 for this term, because because in scenario one you're not renting it out. This term drops out because it becomes irrelevant. Okay. But in scenario two, right? What's it going to be in scenario two? In scenario two, you don't have only capital gains. This is capital gains, but you also have all those, additional cash flows, and you divide it by the initial investment. That will be the holding period return in scenario one and scenario two. Now, if you want to, but it's the same thing. I mean, if you want to do it like, I want to do it, like one by one.
Excuse me,
then,
Professor.
Yeah.
I
Hold
think
on. Yeah, go.
I'm not sure, but I think we end class at 11:50 today.
What's that?
Don't we end class at 11:50 today?
Oh, yeah. The classes, yeah. I'm gonna, yeah.
My bad.
Okay, so let's just wrap it up. So here, in that case, if you want to do it like that, it's the same result. Either way, but that's basically holding period return, and we haven't got to the annualized return, so we're going to get to that next week. But Tuesday, I don't think we meet on Tuesday. It's a holiday, but anyway, so let me. So I'll see you guys, next Tuesday or next Thursday. Please check the calendar, college calendar for holiday. Next Tuesday, maybe not, but I will see you in the next class. Okay, I will stop recording and sign out. Take care. See you guys.
Bye, Professor. Have a good day.
All right, you too.
Have a